Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka.
And hello there, I am Yatin Mota.
Well, Yatin, we were wondering yesterday whether or not the momentum will continue today as well or not. But yesterday's rebound only gained momentum today, and we saw a triple-digit up move coming in on the Nifty, 22,200 on the charts. And this has been backed by broad-based gains, right? Barring a few pockets, all of the sectors were in the green today, and the mid and small cap indices were also outperforming the benchmarks today. So if you look at the Nifty small cap index, Yatin, that was up somewhere around 2%. The Nifty mid cap index was also up 1% or thereabouts. There was a slight hiccup around the around noon, but we did manage to recover from that, and solid close coming in today. Of course, if you look at the NSE advanced decline ratio, almost 4:1, and metals as a pocket was shining bright today as well. 3% up move on the Nifty metal pack. Autos were also leading from the front, and so were the PSU banking stocks, and energy pack was also fairly buoyant. What didn't do well today was the pharma pack and the FMCG pack. Some bit of selling pressure there. But in terms of individual movers today, M&M, Hero Moto Corp, L&T as well among the top gainers, and so were the likes of JSW Steel, ONGC as well as Hindalco. On the flip side, UPL that saw good gains yesterday of 6% or thereabouts. Among the top Nifty losers today, a 5% cut coming in there. Cipla, TCS, Nestle, Tata Consumer and Axis Bank as well as ICICI Bank were some of the losers on the benchmark index. But Yatin, the sector of the day was of course metals, but aside of that, even railways and defense stocks were buzzing, and how on all guns blazing, as you say, for some of these defense names. Take us through them.
So, Nandita, a big comeback for defense and PSU stocks. These were the typical stocks which participated in the rally. For the last 2-3 weeks, most of the PSU stocks are witnessing some profit taking, but today again we saw some momentum come back. Obviously, the defense stocks are in focus after the UBS report, but let's talk about the gainers on Nifty 500. Kochi Shipyard, Railtel, Mazgaon Dock, Engineers India, GRSE, HUDCO. All of these stocks gaining anywhere between 5 to 15%, and clearly all of these PSU stocks have done well. In fact, if you look at the NSE 500, the top 15 gainers, 10 would be probably defense or railway stocks. So good going there. We also had railway stocks like Ircon, IRFC, RVNL. All of these stocks gaining anywhere between 5 to 7%. On the flip side, UPL, that stock went down 5%, Cipla down 4%, Zomato down 4%. So the result reactions and the consolidation thereafter is clearly seen in all of these stocks. PPL Pharma yesterday was up 10%, today profit taking down 3%, Lupin 3% down, the likes of Cera Ceramics, Dixon Technologies, all of these stocks are struggling in trade near the result season. But yes, it was a great day, especially for the mid caps and the metal stocks, wherein the advance decline ratio clearly favoring the advances at 4:1.
That's correct. Good breadth and overall broad-based gains when it comes to the markets. But let's take a look at some of the stocks that we are keeping on our radar this afternoon. Starting with one of the defense name itself, the UBS report on HAL that has fired up the stock today. It has hit a fresh 52-week high. In fact, UBS has upgraded the target price by 44%. Earlier its target price was 3,600 rupees per share. Now it has been bumped up to 5,200 rupees per share, which indicates a near 30% upside potential from current levels. In fact, UBS is fairly bullish on HAL in particular. It expects its order book to triple by FY27, and this could be led by a pickup in large military orders due to a depleting fleet, robust supply chain as well as ready capacity. In fact, the revenue manufacturing growth in manufacturing revenue, so to say, is expected to grow by 25% by FY27 itself. UBS has pointed out that their order intake estimate for HAL is 100% above the consensus estimate. So that's the kind of bullishness we are talking about when we look at UBS's report on HAL. In fact, it expects order wins of somewhere around 5.3 lakh crore rupees over FY24 to FY28, implying a quadrupling of order book by FY28. And of the $60 billion worth of new orders, UBS believes that 20 to 25% could be awarded over the next 2 years or so by FY26 itself, and it has raised its EPS estimates by 4 to 11% for FY25 to FY27. In fact, target revision has been driven by earnings upgrade because it has upgraded the target multiple to 40x from 32x. In fact, it says that the order book scale up, lower competition and greater optionality in exports, these are some of the reasons that UBS has cited for upward revision in target price as well as earnings multiples as well. Recently, Yatin, Nomura had also initiated a buy call on stocks like HAL and BEL. Significant opportunity seen in the defense space, Indian defense space, worth $138 billion over FY24 to FY32. So that's the kind of opportunity we're talking about. But especially since the fact that the shares of HAL have rallied over 400% in the last 2 years, at such a time, we have brokerages initiating coverage on these stocks, right? So you can imagine the kind of runway for growth that we are staring at when it comes to some of these defense names.
And absolutely, Hindustan Aeronautics a dream run. 2 bonus issues, and more demand for the Tejas aircrafts fueling the overall rally. But Nandita, the stock which was in focus today was clearly UPL. That was the top loser on Nifty 500 as well as in the future and option space. Now Motilal Oswal has a neutral call on UPL with a target of 560. Ahead of the result, the stock went up nearly 7-8%. Today the stock was down 4% because the overall management commentary was slightly weak with respect to the overall demand scenario. In fact, Motilal Oswal believes that the revenue declined year on year across region except for EU, which is Europe. The management is guided only for 4 to 8% revenue growth in FY25, and obviously the company targets a free cash flow moving ahead with debt reduction coming in for FY25, and obviously the entire cash flow from operations will be utilized to reduce debt. Now the important part here is despite debt reduction, the cost of debt has gone up because we have seen globally the interest rates have moved up. So the average cost of debt has moved from 6% to nearly 7% now, which clearly would eat into profits. Obviously there is no clarity as to when the Chinese dumping will stop. A lot of products still are pending in the inventory level, and the pressure really on the pricing is there in the marketplace across the globe. Obviously companies like UPL have suffered the brunt of excess Chinese dumping in the marketplace, but yes, the high cost inventory is something which was concerning in the conference call. Post with the stock corrected by nearly 5% intraday, ending the day by nearly 4.5% lower. So Nandita, Motilal being neutral on the stock, but yes, the management expects second half to be good in terms of the margin trajectory.
That's true, Yatin. Margin normalization expected in the second half of this current fiscal. Plus, they've also said that their top priority will be deleveraging the balance sheet. Right. The markets read the comments pretty positively yesterday, but I think today, when you're decoding the finer points and you're reading all the brokerage reports, that's when the bigger picture sinks in, right? So that's one stock that was in focus. The other stock on my radar is PVR Inox reported its numbers just a few minutes ago. In fact, it has achieved pre-Ind AS accounting standards EBITDA break-even. Although the stock was under pressure, net loss also has narrowed down to 90 crore rupees vis-a-vis 285 crore rupees on a YOY basis. Revenues rose 11% and operating profit or EBITDA also jumped somewhere around 31%. Margins came in at 2.7%. Ever since the release of Jawan and Gadar, I mean, we thought that, perhaps the fortunes will revive for multiplexes, but Q2 being a blockbuster quarter because of those movies, didn't really sustain. So, Q3 was also subdued, and Q4, although, looks like it is a tad better than Q3, but, nothing to really cheer about because going forward, the movie pipeline doesn't look all that good, at least till mid-June. The companies also said that, movie lineup is looking promising only post June, and the weakness in the movie pipeline will continue till about mid June or so. In fact, the management has also said that in Q4 the footfalls were lower than Q3 and Q2, and they've maintained a guidance of somewhere around 3 to 4% growth in ticket prices as well. But the growth out there will be a little slower. They have said that they want to get back to 20% EBITDA margin levels pretty soon, and they have done quite a few initiatives when it comes to the cost side. But of course, occupancy is something, occupancy cost is something that is the biggest cost for the business, and they have been grappling with that. But they are also looking to reduce leverage by 50% in the next 12 to 15 months. Going forward, Yatin, they have also actually introduced rather ad-free movies, right, in their premium end of the theatres, and that is something that is expected to improve footfalls. Of course, multiplexes have been facing pressure from OTT, and we've seen declining footfalls, but to ramp up footfalls, they have introduced or revolutionized the movie watching experience. Of course, they will be filling up the gap on ad expenses by introducing one more show for a particular day, right? So we'll have to see how this initiative really pans out, but the management is fairly optimistic. They say that the margin from premium screens are much better compared to the rest of the business. So a lot will depend on how really what kind of response really PVR gets for the kind of measures it's undertaking to increase footfalls. But numbers, I think it was pretty okay, but pre-Ind AS it has achieved EBITDA break-even, and that's, I think, the biggest takeaway from PVR.
Clearly, the multiplex stocks haven't really done much post-COVID, because I think people have moved to online and digital platforms, and some blockbuster movies here and then in a quarter gets them lumpy revenues and profits, but there is no clear trajectory as to how really does a Bollywood and Hollywood movie clearly help them get box office collections, because the journey there also has been volatile. We haven't seen much of activity in terms of blockbuster movies coming in, and the future pipeline also doesn't seem that there are a few new releases which would excite consumers for going to multiplexes. But anyways, that's a debatable point. But as Nandita was mentioning, triple digit gain for the benchmark indices, good bounce from 21,800 levels, and we have been able to really show strength post that bounce back. Let's hope that this week again we should see some stability and momentum in the PSU stocks as well as defense stocks, which could probably continue tomorrow as well.
Well, with that, I think we've come to the end of this edition of Closing Bell. But of course, from me and Yatin, thanks a lot for watching. But you guys stay tuned to Moneycontrol for all your other news and updates.